Welcome to the Deep Dive. Today we are focusing on the Q3 2025 results for Luminar Technologies, which dropped just after the market closed on November 13th.
Yeah.
And let's be clear here. This is not your routine quarterly update.
Not at all. This was, for all intents and purposes, a crisis management call. It signaled a fundamental and I think pretty painful shift in the company's entire direction.
Exactly. So to really understand what's going on, you have to look far beyond that simple revenue line. We need to confront the severe liquidity pressure they're under.
And that's our mission today. We want to unpack this pivotal conversation for you. We're focusing on three things. First, that dramatic retreat away from their core automotive business. Second, the intense and frankly immediate focus on financial restructuring. And third, what the stock's reaction tells us about how investors are viewing this whole high-risk scenario.
So this is really a story of a company pivoting under some extreme duress.
That's the perfect way to put it.
Okay, so let's start with those headline numbers, the ones that gave the market that initial but very fleeting jolt.
Right. So on a non-GAAP basis, the earnings per share came in at a loss of 94 cents.
Which was actually a beat.
It was. The consensus was looking for something closer to a loss of $1.05. So, an 11% positive surprise there definitely gave the short-term traders something to chew on.
And the revenue looked okay too, right?
Yeah. The top line was directionally correct. Revenue came in strong at about $18.7 million, which just topped the consensus of $18.4 million.
So they are showing growth.
They are. It's a solid execution on scaling, 20% growth from last quarter and about 21% from this time last year.
And that jump was supported by increased LiDAR shipments, the series production units. They hit about 5,400 of their Iris and other units. That's up from 4,800 in Q2. So volumes are moving up.
They are. But here, right here, is where the whole narrative completely breaks down. This is what's really important for our analysis. Despite those, modest non-GAAP beats, the official GAAP net loss widened to a massive negative $89.5 million.
Wow. That is a violent swing from the prior year, where they actually had a GAAP EPS gain of 86 cents.
It's a $90 million swing. That's the financial definition of stress right there.
A swing that big can't just be from day-to-day operations. What was behind that massive loss?
Well, the GAAP results showed these huge structural headwinds. They booked impairments and, this is the key part, significantly higher interest expense.
So it's the debt.
It's the cost of carrying that debt. It is visibly crushing their income statement now.
And what about the actual business of selling LiDARs? The gross margin story.
Still deeply, deeply negative. They reported a GAAP gross loss of about $8.1 million. That translates to a devastating negative 43% gross margin.
So for every dollar of product they sell, they're losing another 43 cents just on the product itself?
Exactly. And even management had to admit that selling those series production sensors, the very thing they were built to do, still involves, and I'm quoting here, unfavorable economics.
Which is just a brutal admission.
It is. And if you connect this to the bigger picture, this isn't just a Luminar problem. This could be a confirmation for the entire market that high-volume auto LiDAR just isn't profitable at current prices.
The idea that scale would just magically fix the margin.
It hasn't materialized fast enough, not even close.
Okay, so that sets the stage perfectly. The top line beat is just noise when you look at the balance sheet. So how bad is this liquidity cliff?
It's the central crisis. They closed Q3 with only $74 million in cash and marketable securities.
$74 million, and the debt
is a towering $429 million. And to make it worse, their free cash flow outflow, the cash they burned just running the business, was about $48.5 million for the quarter.
Okay, you don't need to be a Wall Street analyst to do that math. Burning almost $50 million every 90 days against only $74 million in the bank. That runway is basically gone.
It is, without immediate and drastic intervention. This is why they're in full-blown emergency restructuring mode.
And that leads right to the debt itself, the immediate risk.
Right. So management revealed they secured forbearance agreements with most of their secured note holders.
And for anyone who doesn't follow distressed debt, a forbearance agreement is basically the lenders agreeing to hit pause, right? They're not calling the loans due. Yeah.
It's an emergency timeout, exactly. But timeouts always have a clock. And this one is extremely short.
How short?
The relief only runs through November 24th, 2025, just a few weeks from the call. This creates an absolutely critical tiny window for them to negotiate a long-term fix.
Like a debt for equity swap or something similar.
Right, or a full capital restructuring. This uncertainty is why their 2025 guidance is completely suspended. They have no idea what their balance sheet will even look like in the new year.
And the leadership moves they made just scream restructuring.
Oh, absolutely. Appointing Thomas Beaudoin as the new CFO. That's a signal they need specialized crisis expertise. But the most telling move was adding 2 new directors.
Patricia Ferrari and Elizabeth Abram.
Exactly. And why them? They weren't added for their product or sales expertise. They were explicitly brought on for their backgrounds in banking, finance, and restructuring advisory work.
It's the clearest signal you can possibly get. The priority is no longer growth. It's pure capital structure engineering. It's survival.
And part of that survival plan is pernful cost control. The non-GAAP operating expenses did drop a bit to $43 million, but that comes at a huge human cost.
The workforce reduction.
A severe, painful, roughly 25% workforce reduction by the end of the year.
Which is necessary for liquidity, but it raises a challenging question, doesn't it? If you're aggressively pivoting to a new high-tech segment, is cutting a quarter of your workforce, which presumably includes high-level engineers, the right move?
It's a huge risk. They're prioritizing immediate survival over potentially long-term strategic talent retention. It's a choice they've been forced to make.
So that financial crisis is the direct driver of this strategic shift. They're retreating from cars and running toward a new lifeboat.
And the CEO, Paul Ricci, was remarkably frank about what he called the difficult realities in automotive LiDAR.
The full-stack 80s dream is over then.
For them, largely, yes, it's being shelved. They're now focusing on a much smaller, more selective automotive presence purely out of necessity. It's a humbling moment.
What were the specific auto setbacks they mentioned?
While the Volvo relationship is now highly uncertain, Luminar has made a claim for damages against them, and this is the big one. They've paused further production commitments of Iris units for the EX90 and ES90.
Pausing a major OEM production commitment. That sounds like deep, deep trouble.
It is, but here's the crazy part. Management noted that while this will, of course, reduce revenue, it might actually help their cash flow and gross losses.
Wait, selling fewer units helps them lose less money.
Think about that. They are admitting that selling sensors to Volvo was actively burning cash on a gross basis because the volumes were so low. It's a stunning indictment of the current manufacturing environment.
You can't make it up in volume if you lose money on every unit.
Precisely. And adding to that, the Mercedes Halo contract is not expected to continue. They left the door a little ajar for the future, but it's stalled. Only Nissan seems to be advancing.
So if they're running from auto, what are they running toward?
They're pivoting aggressively toward higher margin commercial, industrial, defense, and photonics markets. They're elevating their Advanced Technologies and Services segment, or LSI.
This is where they hope to find some margin stability.
It's built around the same core 1550mm LiDAR platform, but it's for customers who will pay for precision and reliability, not just the lowest consumer cost. This segment is already about a third of their annual revenue, and it's growing.
And they gave some great specific examples of this.
They did, working with Caterpillar on heavy off-road autonomy, partnering with a company called Forbearance on systems that work without GPS.
Which is a huge deal, given all the GPS jamming and global security concerns. That's a real niche advantage.
It is. And they're also seeing interest in aerial and marine applications, like using their sensors to help helicopter pilots identify power lines. Management is arguing that LSI offers better visibility, multi-year orders, and strong tailwinds from defense budgets. They think it's a deeply under-recognized asset.
Okay, so let's look at how the market reacted to all of this. The beat, the debt, the pivot.
Yeah.
It seems to encapsulate the whole binary nature of the situation.
It does. The stock is trading purely on transactional optionality now, not on fundamentals. That after-hours pop where the stock spiked 14%,
Yeah.
that was pure relief. Relief that the earnings beat meant it wasn't the absolute worst-case scenario, combined with the fact that they officially announced a strategic review, which means a potential sale is on the table.
But that relief just vanished.
Almost instantly. By the next regular close, the shares were back below where they started. That tells you that the longer-term investors are focused on one thing: the deep-seated liquidity risk and that towering debt load.
And the options market saw this coming.
Oh, yeah. The implied volatility going into the print was massive. The market was pricing in a potential 21 or 22% swing up or down. That shows you just how speculative this has become.
And all that speculation is focused on these strategic alternatives. A sale, new capital, a restructuring.
Exactly. And they've hired Jefferies, Weil Gotshal, and Portage Point to advise them, which confirms just how serious this process is.
And then there's the wild card.
The M&A overhang from the former CEO and founder, Austin Russell. He's filed a proposal to potentially reacquire the company.
So you have competitive tension building around these assets.
You do. You have multiple sophisticated parties circling who all know that the core technology is valuable, even if the current capital structure is completely broken. The stock is a distressed equity play, plain and simple.
Okay, so let's pivot to our This Is Not Financial Advice segment. For the speculator who loves a high-risk, high-reward bet around a situation just like this, what's the outrageous but plausible trade idea?
The thesis here is incredibly simple. The equity's value today is entirely based on who buys the company, or maybe just the LSI unit, and at what price relative to that $429 million in debt. The stock's basically a lottery ticket.
So we need a cheap, leveraged bet that capitalizes purely on a sudden, positive M&A announcement.
We can structure a long-shot synthetic play. In plain English, that just means using a combination of calls and puts to create a very specific leveraged position. And we'll focus it entirely on that M&A timeline around the November 24th forbearance deadline.
Okay, so what are the specifics? What's the two-sided bet?
You look at buying a deeply out-of-the-money short-dated call option. Let's say, for example, the December $2 strike.
The stock's at about $1, so that's a bet on a massive pop.
A massive pop driven by a buyout, exactly, and it's cheap. At the same time, we can use the high put interest in the market to help pay for it. You sell a protective RMR, put slightly below the current price, say the December 50-cent strike.
So you're selling someone else the right to sell you the stock at 50 cents, and you use that cash to help pay for your $2 lottery ticket.
That's the rationale. It creates this highly leveraged structure. If a bidder, whether it's Russell or someone else, steps up at a price well above $1.50, you capture huge leveraged upside from that call.
And the downside.
If the restructuring fails, the equity gets wiped out, the stock goes to zero, you only lose the small net premium you paid. You aren't exposed to the full downside below that 50-cent put you sold. It is a pure binary bet on a quick deal getting done.
So to wrap this all up, this deep dive has covered a really stark transition. Luminar is moving from a high-growth, auto-centric story to a restructuring stage photonics platform.
The results offered that modest beat, which provided some temporary relief, but the whole narrative is just dominated by the $48 million quarterly cash burn, the crippling debt, and that looming November 24th deadline.
The company's future now hinges entirely on the success of that strategic review and whether this defense and photonics pivot is viable.
Management is banking everything on LSI and its 1550mm technology. They're hoping it can provide better margins and more stable revenue than the auto business ever could.
But given the urgency, given that clock ticking on the debt, you have to ask the final question. Can the technology's intrinsic value be monetized fast enough to outpace the immediate and very real risk from the capital structure?
That is the ultimate trade-off, and it's the question facing every single person holding that stock today.